M&M is the top Nifty gainer. Brokerages are positive. Jefferies and Kotak continue to remain bullish on the stock following a strong set of numbers from the automaker.
Shares of Cummins India correct 5% after its parent company withdraws its guidance for 2025 on tariff uncertainty. The Indian power generation business has also seen 11% decline in revenue in the quarter ended March 2025.
Indian Hotels sees profit booking. The stock is lower by about 3.5%, even as the company has posted a good fourth quarter performance. Stay tuned. MD and CEO Puneet Chhatwal will join in shortly to discuss the numbers.
Yes Bank gained 5% in early trade on reports that Japan's Sumitomo Mitsui Banking Corporation will pick up 51% stake in the bank. The stock, though, comes off the day's high after sources tell CNBC-TV18 that such reports are actually incorrect.
Electric two-wheeler maker Ather Energy lists with gains of about 1% to its issue price. Thereafter sees some selling in light of the market weakness right now. CEO Tarun Mehta will also be joining in to discuss the company's post-listing strategy.
Hello and welcome to Chartbusters. We are coming to you live from the CNBC-TV18 Motilal Oswal studio. I'm Nigel and with me is Mangalam. And as you can see, all the top indices should come up for you. Actually, to the top of the screen, it's telling you that the markets have come in for some mild profit taking today. The headline index is down by close to around 80 points. The Nifty Bank is down close to around 350 points. Odds are that at 54,100 on the Nifty Bank will hold out. However, the Nifty is lower. I think besides the headline index, Mangalam, the other two indices, the mid cap as well as the small cap indices, they're coming for some, more selling pressure. And that's why the advanced decline ratio is firmly in favor of the declines as we speak.
Nigel, cues for consolidation. That's exactly what is coming across right now. And, news overnight with regards to developments around the border and the mock drills, etc., are, not really denting sentiment, but ensuring that people are a little cautious and ready in terms of booking their profits as well. We've seen a good run. The Nifty holding around that 24,375 mark. We have a lot of results which are actually being rewarded fairly positively. We have CCL products, for instance, which are 14% after a solid set of numbers that came by. And the decline in crude prices has meant that we've seen decent traction for names like CEAT as well. Reported its results last week, has continued to do well, currently at the high point of trade for that stock as well. And then we do have a bunch of others which are seeing some bit of profit taking, most notably from the travel and tourism space. We have Indian Hotels, a good performance coming in, the 12th record quarter for the company. But despite that, remember, this company's seen a stock price surge as well. So maybe some bit of profit taking is what we're seeing on that stock. Indian Hotels is the one that we're talking about. So let's go straight across to Puneet Chhatwal, who's the MD and CEO of the company, who joins in to discuss more about the quarter four results, but more importantly, the FY26 outlook. If you look at it, the company on its part has said that they are looking to open 30 plus hotels. They're looking to, focus more on the revenue per available room, the RevPAR that is, and at the same time are also looking to channelize the growth coming in from the MICE or the events segment itself. Puneet Chhatwal joins us now. Thanks a lot, Mr. Chhatwal, for joining in. In the conference call, you did say you're confident of double-digit revenue growth in FY26. If you could quantify that top-line target for us, is it mid-teens, is it low teens, is it low double digits or high double digits? And if you could break that up for us across, brands, occupancy, same hotel growth, pipeline additions, and average room rates.
Thank you. Always a pleasure to have this call with you, Mangalam. We are looking for anything which is between 12 to 15% top line growth, obviously very strongly driven by the Taj brand, and also a strong contribution, anything between 35 to 40% from the new businesses, which is Reimagined Ginger, the Tree of Life, Ama, and Cumin. The other brands are also in a growth phase, which is Vivanta, Gateway, and Selections. But the majority of the growth coming in on a very strong basis will be from the backbone, that is the Taj brand, and also very strong contributions from the new businesses, which at a high margin also help or have helped us in the past in retaining and also increasing our margins. Occupancy remains robust in most of the Indian markets. I think the only place where the occupancy or rates are not increasing at a very high level, I repeat, at a very high level, is Goa, because it had seen very big highs in the last 3 years. So I think for some time, some consolidation is needed, and then it will start going up there too. But Delhi, NCR, and Mumbai remain very strong. The month of April for our company has seen a 17% growth. May is looking good. This is 17 versus last year April because of the excessive heat and the code of conduct. All in all, I think the outlook is positive. Also because instead of 55, there are 70 wedding dates in this financial year, which is the highest that we would have seen in the last 3-4 years. And with all the delegations coming into India, the foreign delegations interested in doing more business with India, I think it's helping a lot, especially in the capital city of Delhi, to grow both rates and occupancies.
Got it. All right. Hi, Puneet. You're sounding confident about business. Good start to the year as well. And as you said, the Q1 will look much better because of higher weddings as well as on a lower base. So I think as you have guided the street as well, that we should be looking at on a combined Q1 and Q2 together because there'll be a bit of lumpiness. So we'll keep that in mind. Let's focus on a couple of aspects. As you said, new businesses will contribute close to 25 to 30% of the total mix. What is the growth you're penciling in there? I think from around 400 crores, you've grown that to around 600 crores. This year, what do you look to end it at?
We think we should easily get anything between 800 to 1,000. That's what we are targeting. And mainly this year, driven by Ginger and towards the second half also by Cumin and Ama. Cumin has been doing quite well. It achieved almost a GMV of 150 crores. We're expecting it to touch 200 this year. And Ama to get closer to 100 crores over the next 2 years. I think this year it'll go closer to 60 in GMV and then finally to 200 because of the addition of 100 bungalows in last financial year and 100 in the previous one. So we expect to see an acceleration in openings in that homestay business this year.
Got it. And what targets would you set for Taj Sats, which did about 1,051? You have a new kitchen coming up at the Jewar Airport. Chambers, 150 crores is what you garnered in terms of fees in FY25. What's the target for next year? And the management fees itself, that's about 562 crores. What's the target for next year?
I don't think there are targets, Mangalam. The only thing you can expect compounded annual growth on management fees of around 20% or fee income by 20% like we have had last year, despite the base becoming much larger. But we're also going to open more hotels. So last year we opened 26. This year we'll be opening 30. And many of those hotels that you open take 5 or 6 months to get, get off any kind of teething issues, another 2-3 years to stabilize. So a lot of openings that have happened in the last 2 years and will happen this year and the next year will keep adding to the fee base significantly. And also with the new additions and the new conversions that we are doing. So you can expect management fee income to keep growing at 20%. Chambers is not something which we want it to be like a mass business. It's a very selective business. It's a very tough criteria to become member of Chambers, but because of the growth in the footprint. So we renovated last year the Kolkata Chambers in Taj Bengal. As we speak, we are renovating the Taj Mahal Palace Colaba, which is doubling in its size. We'll be adding a new Chambers when we open Frankfurt in this financial year. So that will give us international presence in Frankfurt, London, and Dubai. So given that footprint, I think even Chambers is expected to keep growing at a similar pace as you have seen in previous years.
All right, Puneet, kudos to you as well as the team in terms of operational efficiency. Margins have perked up as well, but what are the levers you have in place now to further improve margins from here on?
Well, Nigel, so if we turn the clock back, we used to do 12 to 14% margins till 2015. And the first time when we guided on 25%, not many people believed us. Now we are at 35 on a consolidated basis, and on standalone, it goes as high as 47, 48%. I think these are very healthy margins. If we can maintain those in the same level, I think we are doing well. We should not forget we are a capital and a labor-intensive sector, and we need to keep investing into our properties, and not everything is capitalized. Some goes into the normal day-to-day maintenance of the wonderful iconic assets that we have. And that is a key. We want to maintain the exclusivity, the luxury status of the Taj, and keep renovating our old gingers into the lean luxe proposition with cumin. That means insourcing of food and beverage, unlike what was done earlier. So finding the right balance between investments, capex, margin expansion, and the growth, so that we are positioned well, not just from quarter to quarter or year to year, but for the decades to come.
Take that point. Just a final question before we let you go. Puneet, you've been credited for turning the business, a very strong business, around on all fronts, be it the balance sheet, the revenue, or diversifying away from the main brand as well. The one fly in the ointment, however, is the holdings that you have in some companies. You have Taj GVK, where it's around 25.5%. Oriental Hotels, it's about 33.5%. Wondering if there is some sort of restructuring taking place out there as well for you to further consolidate all your positions and streamline basically the holdings that the company has across the board.
We've done a few of the consolidations in our drive for simplification, but as we are a part of the Tata Group, and Indian Hotels is the oldest operating company of Tata Group, we honor all our partnerships and all our contracts. If any partner comes to us and wants to exit a business or wants to give us a larger share, we will be very happy to look at it. Today, with net debt zero and with a lot of gross cash, we are very well positioned to take advantage of within group or outside the group companies for any M&A activities that might come. But as and when it is that far, Mangalam, I will be happy to share that with you. But at the moment, we don't have any such activity going on.
Nothing in the near future? Nothing can we hear from you on Oriental?
You mean Oriental Hotels?
Yes.
OHL? No, I first thought you were talking about Orient Express. We exited that long time.
No. Oriental Hotels.
No, nothing that you can hear from us on any of the companies that are there, and definitely not on your channel live.
All right, Puneet, good to have you on the channel as always. Thanks a lot for speaking to us here on CNBC-TV18. It's been a great year, and you've started off FY26 on a positive note. We look forward to interacting with you on and off the record as the year progresses.
End on that note, I always do on your channel, the best is yet to come.
Got
always.
Got that, Puneet. Thanks a lot for joining in, and that comment as well. Definitely, guys, for better times going ahead. Well, let's focus on the next management, though. Ather Energy, that's the one that listed and had a pretty good listing. The stock actually had opened up in the green. However, from the top, we have seen some profit taking. Markets aside, let's understand business. We have with us Tarun Mehta, Executive Director and CEO of Ather Energy, who joins us on the show. Hi, Tarun. Good morning. Good to see you. Well, it's been quite a journey for you. So congratulations on getting listed on the Indian bourses. And we welcome you to the stock exchanges, and we look forward to interacting with you, as this journey progresses. That said, post raising some money from the market, well, your balance sheet is looking in much better shape. And now a lot of focus will be on the operational efficiency. So give us a couple of numbers. What kind of a volume growth can you guide for this year? And what kind of a market share are you looking at? The last time around, I recall you were telling us that it had perked up to the mid-teens. But what is the range we should work with for the year? Go ahead.
So last year was FY25 was a pretty important year for us. We finally launched our more mass premium product Rista, and that's really starting to turn things around. Historically, Ather used to be very strong in South, where we continue to maintain our leadership position as recently as last quarter. But the rest of the country is where we hadn't pushed aggressively enough in the past. With the new product, we found a lot of success. You will see market shares have trended up really, really well in the states of Gujarat, Maharashtra. Gujarat particularly is a great success story at touching and crossing 20% market share multiple times. I think this product is finally starting to take us mainstream, especially in the non-South markets, which is also where a lot of our expansion is going to come from. But even before that expansion really kicks in, you will notice in FY25, three-quarter data that's already out there, we've already grown 45% in volume. And remember, this growth has come only on the back of most of this growth has come back on the back of new product. The distribution expansion that this product unlocks is still a journey ahead of us. So we are extremely bullish about the near-term growth because of distribution, because of how Rista, a new family scooter, is landing in the market, and generally how well the India premiumization story is really, really taking off, where Ather really plays in the center of it.
Indeed, Tarun. Tarun, we have a little bit of a timeline, but we have understood that business, and you have made a couple of these points as well pre-listing. If you could tell us, because of this new product launch being accepted so well, and because of the higher market share that you have in Gujarat as well, what is the volume growth you can guide us for this year? And what should be the targeted market share? In Gujarat, you've done much better. From early teens, you've gone to mid-teens. Where do you see this number stabilizing at? Two numbers, growth and market share.
Overall, I think both margins and volume and market share, all three should trend really well this year. I am personally definitely expecting an even better trajectory than what we saw in FY25. Gujarat was, in my opinion, just the starting experiment. I think there are states of Maharashtra, Madhya Pradesh, Orissa. I would say all these states have responded really well, and we are very, very, very excited about them. Obviously, I can't give you a specific guidance yet, but wait for results and wait for more commentary. But these are the places where I'm very excited, and only one of those states is where I'm still talking about the actual numbers. As all these states really start to fruition out, very bullish.
So last year, in the first 9 months of this financial year, volume growth was 45%. You believe you can better it over FY26 because of the product that you have as well. And a large part of that, while it comes from your new product, also comes from distribution expansion. If you could give us some sense on how many distribution centers are you likely to open over the next 12 to 18 months? You, as of filing, had around 265 experience centers. So then by that measure, we'll get a sense on how your volumes are likely to pan out as well.
The stores have been expanding very, very, very rapidly in the last few months, particularly, and you will keep hearing about this in our commentary going forward. Let me just give you some context. 260 odd stores by December. Most of our industry peers are at between 700-800. We even hear 1,000 plus stores already live. There are hundreds of cities across the country where Ather has not even opened its first store. And honestly, we held ourselves back in opening stores in these cities in the past because we had a very premium product which would not have been the right fit in these markets. But with Rista, I think all those cities are fair game for us. So honestly, we think that the timeline is right for us to now take our distribution at the same level as our peers. And because we have a capex-like distribution model, because it's via partners and dealers, we are very confident of being able to scale up our distribution really, really rapidly in the coming few months. So, but that's a headroom for growth here. We are at about 260. Our peers are at about 800, maybe 1,000. And I believe those numbers are probably the right long-term numbers, maybe even short-term numbers for us to focus on.
So how long before you get to the industry level of 700, 800 dealerships? And because you can scale up a lot faster, does that happen in FY26? Does that happen in FY27? Yeah.
No specific guidance. No specific guidance.
All right. We tried a lot.
No, Tarun, but you have to give us this number at least. What about on your cash flows? The cash flows are still negative, and last time we spoke, you told us it's headed in the direction that you turn into a positive number. This regulator has got you on board. They are happy with the performance you have listed. No one's toying with the law. You can tell us now. When do you expect to turn cash flow positive? Will it be FY26 or is it FY27 or is it later?
I will still skip specific guidance like this. What I can talk about, however, is that in our case, because we are comparatively not as capex heavy as some of our peers, we believe the journey from EBITDA break-even to PAT and cash break-even is going to be a pretty small one in our case. Like literally the largest capex that we've called out is for the next large mega capacity at Aurangabad. But outside of that, stores are not ours. We are not into cell manufacturing. So our overall capex is relatively light. So I believe our EBITDA break-even timelines and our cash break-even timelines are going to be very, very close to each other.
Okay, if you could give us a sense
obviously, I'm very positive, very excited.
Right. If you could give us a sense of at what capacity utilization or at what volume run rate do you break even?
Actually, capacity utilization is a very old way to look at this, and that actually has a limited impact in overall profitability. We've seen our capacity utilization go from 25 to almost 40, and I think just this last festive it was touching 60%. Capacity utilization has gone up well, but the bigger impact on profitability is really coming on back of volume, which is why I'm again and again keeping us focused on how volumes are trending up, because fundamentally the unit economics that we have cracked, and remember our unit economics is a very clean one. We don't run our own stores. We have very limited dependence on subsidies. It's only one central government subsidy of 5,000 rupees. So the margin is quite fundamental and quite dependable. That's trended really well. So margins are at a good place. It's all eyes on volume now. As the volume grows, and hopefully on the FY25 trajectory or better, I'm very bullish on profitability in the short term.
You know, one question that everyone's been asking is you're functioning at a lower capacity utilization level, yet you're going ahead in your increasing capacity. One would argue that it could give negative operating leverage. But you're saying you're seeing the path where demand is going to be strong and your volumes are going to rocket. When do you hit 1 million units of capacity? You're going to be at around 1.45, I think, post this capacity addition. 1 million, the target by when?
Yeah. So our current capacity is 35,000 units a month. Just see our trajectory on this case. October 23, we were 10,000 units in the festive month. October 24, next festive, we've scaled up to 21,000 units on a total capacity of 35. At this rate, honestly, I'm actually worried about this coming festive in October 25. I think business is scaling up really well. Customers have responded really well. So I'm very bullish on capacity utilization. Our next increment of capacity is another 42,000 units a month, which is what's coming up in Aurangabad. And then there is another phase 2, which is an incremental 42. So that's how you add up to 1.45. But phase 1, Aurangabad, over the next year or two, will scale up to roughly about 1 million. And obviously, I'm bullish about getting to sort of moving on the trajectory really on the same timeline.
All right, we take that point, Tarun. Thank you so much. We tried our best to get in some guidance and, numbers and specific timelines, but you were good enough in skirting all of those. But mind you, once you report your results, we're not going to leave you. We're again going to push you for all these numbers, operational profitability, market share targets.
I've mentally signed up to do this every quarter.
Perfect.
Do this dance.
That's your responsibility as the owner of a company towards shareholders.
You know, Tarun, for today, you go ahead and you celebrate this feat. You know, it's a big day for you as well as the team. So celebrate it. We look forward to chatting up with you soon, and hopefully we'll get a couple of more numbers out of you. But for the day, celebrate it. Well, on that note, though, I think we should slip into a short break. Come back. We'll continue to focus on markets.
Welcome back. The cut is deepening a little bit, but nothing really which is worrisome. So in this market, what do you do? Get you a few ideas for profit. And this one comes in from Money Control Pro. Bharat joins in with a stock that he's been tracking. Bharat.
Challenges will be semi-hotels limited. The demand momentum continues to remain strong, both for the corporate and the leisure side. We expect the company to deliver double-digit growth in Q4 FY25. The hotel industry upcycle is expected to sustain over the next few years, with demand expected to outpace the supply. This is positive for the pricing growth and a positive development for hotel players like SAMHI. SAMHI Hotels' GIC deal to create an investment platform for upscale and higher properties is a significantly positive development. As a part of the transaction, SAMHI will provide 4 operational assets and 1 asset under development to the platform for 65% stake. GIC on its part will infuse rupees 750 crore for about 35% stake in the investment platform. The platform will significantly reduce the leverage for SAMHI. We expect SAMHI's debt to EBITDA to reduce from 4.9 times currently to 3.5 times post the deal. The deal will not only deleverage Semi's balance sheet significantly, but also enhance the growth prospects. At the current market price, the stock is trading at an EV by EBITDA of 13 times FY26 projections. We expect Semi's multiples to re-rate year on, and hence recommend investors to add the stock more. Thank you.
Okay, thanks a lot for that, Bharat. Well, we'll time to slip in a short break, come back, continue to focus on markets. Welcome back. Well, as we speak, the market's seeing some bit of a recovery from the lows of the day, Mangalam. So, we're trying to defend, I think, the 24,350 mark on the downside. At the upside, we have seen resistance numerous times come in at around the 24,550 odd mark.
I'm looking at a couple of stocks as well. Paytm, for instance, has now fallen to the low point of trade, and that ahead of its numbers today. So we'll keep an eye out on that. But as we wind up on this edition of Chartbusters, you stay tuned to CNBC-TV18 as Trading Hour comes up next.